I select the team is focused on entrepreneurship, specifically because in the 50s and the 60s, the US saw annual growth on the order of 3 to 4% in GDP. Companies were being started and grown in every major city in the country. The results of those companies being started or growing were stronger school systems, stronger economies, stronger regions. It slowed down in many ways as companies grew bigger and the economy shifted a bit and our focus in various ways changed. And our growth in GDP has been declining. We've moved more offshore, we've stopped innovating as much, in as much as we see some pockets of innovation that are exciting, we're not applying those same principles elsewhere. When we think about how to get back to 4% growth, from a macro perspective, the notion of investing in more companies in all the major cities is a forcing function in a sense to help grow the economy. And we should see, if we have a lot of activity going on throughout the country, we should start to see growth get up to about that 4% level again. And here's the advantage of 4% growth. At 4% growth, the taxes that people pay, the income taxes that people pay, the growth in GDP, the activity, the productivity gains that occur in that type of market, take all the challenges of national debt and you start to see the resources get balanced out and it pays down the debt. If everybody is employed instead of on welfare, then they get health insurance with their company. If they've got health insurance with their company, they've got less stress on their life. Their family lives are easier. They're able to feed themselves better. They're healthier. They have more enjoyment in life. It creates a more resilient economy in which, okay, right now maybe IT technology is back down, but ag technologies are moving ahead. And as a country, we create more diversification in terms of the industry base that we have and are more resilient if we have an oil shock, or if things change in China, or if things change in the Middle East. It creates strength in the overall country where other people find it appealing to work with us and come and get educated here and tie into our culture. And the trigger for that, though, is the entrepreneur. Silicon Valley grew in the 90s, this is not well known, in the 90s, for the most part because of the innovations required to grow Walmart. Sam Walton was changing the retail experience in a way that other people copied, that led to IT requirements that drove things in Silicon Valley. So the economy is a fairly integrated entity, and a success in Detroit, a success in St. Louis has a ricochet effect to the rest of the economy and all the other pieces and parts that need to come together to build it. The other part of the 4% is we're not done. If we look at the massive innovations that have gone in IT technology, the massive innovations that have gone on in IT, in retail, are we seeing the same massive level of innovation in education, in healthcare, in transportation, in energy production? We haven't quite seen them yet. But we will. There will be some point in time in our future we will, and we will both grow our own economy in that process, and that same technology will move to a world stage. So I select as focus on getting more capital to those entrepreneurs. Those entrepreneurs will dig in and develop the unexpected. The unexpected will drive productivity. That growth and productivity will grow GDP to 4%. And once we get up to a level of 4%, budget deficits will collapse. The economy will get smoother. We won't be having to make compromises. And we'll be back to an economic situation that we had in the sort of 50s, 60s timeframe, where we had a very broad, resilient economy across multiple industries.